chapter 4 of our introduction to cryptocurrency coursework. And in this chapter, we're going to cover it in three sections. The first section is technical analysis, which we are going to cover in this lesson. And in the technical analysis side, we're going to cover three key things. That is trend analysis, support and resistance levels, indicators on oscillators. Let's dive right in. Crypto technical analysis is based on past trends, meaning this factor is important to understand. Please remember that past performance is not always indicative of future results. Trend lines are one of the most transparent crypto indicators and are created by drawing out a single line connecting the different high and low price levels or price points. Ultimately, the more price points you connect, the stronger the trend and easier it is to identify the potential future market trends. I know you may have seen some maybe charts where somebody has drawn out lines connecting different price levels. So, for example, you can draw lines maybe for local tops. You can connect maybe two high points or more than two, and this shows more of a pattern. So you can see maybe for here we can see the high points is more of a inverted triangle, and based on these patterns that are formed once you connect different price levels, you can be able to identify the pattern, and based on the pattern, these can help this can influence you in determining the right price movement. So trend analysis are very important. These patterns that you can come up with have been studied for years, and you can always check them out. There are thousands of them. These patterns in particular, and different patterns mean different price actions. So that's why it's very important to be able to understand the trend analysis. And again, just because there is a pattern doesn't necessarily mean or indicate a particular or a certain future result. So these are just there to help you or guide you in and speculating the right market direction. And the next thing we're going to cover is the support and resistance levels. This could be a powerful crypto indicator for identifying the key entry levels and exits. They represent where the market has made past peaks and falls. Trend lines can be helpful in determining if a price is if a market is range trading or showing signs of directional trend. Many traders will rely on Fibonacci retracement and expansion levels in helping identify levels the trend could target or potentially form a reversal pattern. The Fibonacci retracement is based on the Fibonacci sequence, as you can see here. This is a series of numbers where each number is the sum of the two preceding numbers. So this technically means if you sum up the two previous numbers, they will give you they should add up to the third number. For example, if I have 3 as the number, it means that what can I sum up to get 3 as the third number? That is 2 and 1. So the previous two numbers should be 2 and 1. So, and this sequence starts from 0. So you can start from, as your first number is 0, the next number should as well be 0 plus 0 is 0, so we can go to 1. We go to 1. 0 plus 1, it still gives you 1. 1 plus 1, then we can get 2. And this is how it goes. 2 plus 1, we get 3. 3 plus 2, we get 5. So this is how the Fibonacci sequence goes, and this is what many traders use to identify, where the price or the direction of the market. To generalize, resistance levels are points where prices are repeatedly pulled back, and support levels are where it has bottomed out. If the market price continues to rise above resistance, it shows that the coin has upward momentum and could break out from the mid body. Meaning, so for example, if we have a certain price range, so for example, let's say for example this is your resistance level, it means that the price doesn't go below this point. Every time maybe it hits this certain price, it goes up. It continues to rise above the resistance level. Whereas if the price are continuously bottoming the support, it indicates the opposite. So it indicates the support is maybe the price has gone up. So for example here, I'm taking this point as an example. It shows that the support, if it reaches here, it bottoms out, it goes bottom, and the resistance, if it reaches the bottom point, you'll be sure that maybe the price would go up, or not be sure, but potentially it could go up. And these are the points that maybe you can connect with your trend lines and maybe form a pattern, and you can be able to study that pattern and what it means for your trades. The next thing are indicators and oscillators. We've discussed indicators before. Maybe to touch on them again, these are tools used to predict future price movements and determine the overall strength of price trends. These indicators are there to reinforce the trends. These are the indicators. They reveal the trends of the market. So you use indicators to study trends, and you'll be able to learn about various indicator oscillators, like relative strength index, the moving average, convergence, divergence, that is the MACD, and others. So again, these are indicators. These are the MACD. You can see. Let's see where. So you can see this is the RSI. This shows relative strength in how strong has these trades been. So you can be able to tell from that, and the moving averages based on how the market has been behaving. So we remember there are so many indicators that you can use on your trade. This is just to mention a few you can use. Maybe you can research what all this means, because you're not going to cover them on this coursework. This is just an introduction rather. And this marks the end of our first lesson on chapter 4. I'll see you in the next lesson.